Hello everyone. Markets are just flip-flopping based on risk on, risk off. The last 24 hours were risk on for some reason, and the dollar was lower against almost everything. All the G10 currencies and all 15 emerging market currencies that we track. But from my point of view, it's very hard to see why. In fact, it seems to me that the tension in Ukraine is increasing, particularly after the EU agreed on possible sanctions to take against Russia, and the head of the U.S. Joint Chiefs of Staff, the top military official in the U.S., said that in the case of an escalation of unrest in Crimea, the U.S. Army is ready to back up Ukraine and its allies in Europe with military action. That's pretty serious from my point of view. So yesterday's movements overall remain a mystery to me. And personally, I prefer not to invest based on mysteries. The reality is that the Ukraine situation is getting worse, and the dynamics that have started in China have yet to play out, at least play out fully. So I'd expect more days like Tuesday, risk aversion that pushes the dollar up, than like Wednesday in the near future. Now, overnight, the Reserve Bank of New Zealand met and hiked the official cash rate by 25 basis points, as was universally expected. The RBNZ said it expects it to raise the OCR by, quote, about 2 percentage points, unquote, over the next 2 years, depending on economic conditions. Although their forecast for the 90-day bill rate implies that rates continue to rise further well into 2016. The projected tightening is a bit faster and longer than had been anticipated. I think this course will distinguish the New Zealand dollar out of all the G10 currencies, especially as the euro and some other countries like Sweden and Switzerland are struggling with deflation. And they're actually pushing out the eventual start of their rate hiking cycle. One analyst was quoted as saying, "We're on a different planet here." So I think the New Zealand dollar is going to remain strong. Now, as the European day began, China announced that retail sales and industrial production slowed dramatically in the first 2 months of the year. The news corroborates the message from the surprisingly weak trade figures China released earlier, and I think it's likely to depress market sentiment. No indicators worth talking about today from Europe. In the U.S., we get retail sales for February, which are expected to be a bit higher. Also, initial jobless claims for the week ended March 8th are expected to show a rise, but the closely watched 4-week moving average is expected to fall slightly. So those two indicators could provide some support for the beleaguered dollar. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.